Hey guys, this is Jeremy Nakori here with Trading for the Benjamins. And I want to create a series of videos really mainly because I know there's a lot of people out there that really want information on the foreign exchange market. And there's a lot of things on YouTube that can distract the masses and to make a lot of things more simpler. I wanted to create this series of videos. This is the first video of many videos that I will create, mainly, like I said, to help out traders, beginner traders, mainly to help succeed, and hopefully maybe in the future we can end up working together somehow, some way, on some type of investment, right? So, like I said, first things first, my name is Jeremy Nakori. Um, Whenever you get onto the charts, I'm really gonna dive deep into this. I know this is gonna be a YouTube video, so this is not gonna be too in depth, but I'm going to try to be more direct here to help everybody out. So as you see, this is a little demo account right here. So what you see, this is straight demo money, not real money right here, because I want everybody to feel very comfortable, um, not to be looking at what type of profits I have or the balance that I have, the capital that I'm managing or whatever, because currently I'm currently a FTMO trader, which if you don't know who that is or what that is a funding firm that funds individual traders like myself to be managing large sums of money or capital, depending on however you want to call it or consider it, right? So first things first, whenever you get onto the charts, the first thing that you want to actually do is actually, one, know what you're trading, right? Because if you do not know what you're trading, this is going to be a long trading lifestyle for you. And okay, let me first give you the three keys to trading right here. All right, three keys before you keep trading is rule number one. All right, the key number one right here is trust the process, guys. Trust the process. I'm gonna say that one more time. Trust the process, because this is going to be a process, a long process within your trading journey that you're going to be going. Wait, maybe you might be trading by yourself, or you looked up and found this video and you're trading by yourself, or you might be on a trading team. I know there's a lot of multi-level marketing groups out there, investment groups out there, that you might be individually looking to expand your skill set or expand your knowledge in the foreign exchange market. And you might have been doing it for a month or 3 months or 6 months or even a year or 2 years or 5 years, and you're like, damn, 5 years. But you never know, because 12 months can change your whole life. I mean, I literally tell everybody to, if you're going to get into something like this, be able to commit 12 to 18 months to this. 12 to 18 months to this, because that's how quick your life can change in a year or 2 years. Your life can change completely. Like, your life doesn't have to be the complete same as it was the last year or the last 5 years or the last decade. You can change your whole entire life. This is 2020. I know all of us are going through different chapters and seasons in our lives, and we're all looking just for that one vehicle that we believe that can actually take us to the destination that we really want to go to. And the first thing you have to do about that is just trust the process. Key number two, know what you're trading. I know I mentioned that earlier today. Know what you are trading, guys, because there is all different pairs. There's the US pair. Let me actually show you. Um, there's the US pairs, there is the euro pairs, there's the pound pairs, there's the the Japanese yen, and there's the Swiss, there's the Australian dollar, there's the New Zealand dollar also, guys, and then there's the pound and the euro, like I mentioned earlier, right? And then we got our exotic pairs right here, where the US dollar, the Mexican peso, the South African dollar, or whatever you want is all here that you can all trade. All countries' currencies, you can literally trade in this foreign exchange market at your fingertips. So if you're trading the Australian dollar against the Canadian dollar, right? It is important to know what you are trading, guys, because Australian dollar, understand these are different economies that you're trading. So the Australian dollar, their 9 a.m.
It's 5 o'clock.
Their 9 a.m. is completely different than if you're living in the if you're living in Texas, right? That is the central time zone. So if you're living in Texas in the central time zone, you are way back, pushed back from them. You're about a good almost a whole day pushed back behind them, right? How it's 5 o'clock here in Houston, Texas. Well, I'm in Austin, Texas right now. So it's 5 o'clock in Austin, Texas. And just now, an hour or two later, it will be 9 a.m. Or if it's not 9 a.m. right now, it's 9 a.m. Let me check my phone. Let me make sure. Give me a second. Let's see. Let's see. In Australia, it is currently 8:31. How? I don't. I don't know how it's 8:31, but it says they are 15 hours and 30 minutes ahead of me, where I'm currently. It's 5 p.m. Right? It's currently 5 p.m. for me right here in Houston, Texas. So they're 15 hours ahead of us. So their 9 a.m. is in 30 minutes. All right, 30 minutes. So the Australian dollar, of course, is going to be stronger entering into this new trading session right here. So, and then you guys, it's against the Canadian dollar. So obviously the Canadian dollar is in the same hemisphere, in the same area as the United States. Canada is right above the United States. And depending on where you are in Canada, you could be in the same time zone as me. So their 9 a.m. is probably the same 9 a.m. as the New York Stock Exchange opens. So, and the New York Stock Exchange opens an hour before me. So their 9 a.m. is an hour before. So their 9 a.m. is where it's 8 a.m. for me in Austin, Texas, right? So that's probably the most reasonable time that the Canadian dollar is going to be more volatile in the market. The Australian dollar is probably going to be more volatile in the market within the next 30 minutes, guys. So it's important that we know what we're trading and understand, okay, if it's the Australian dollar, if the Australian dollar is listed first against the Canadian dollar, if the chart is going up, that means the Australian dollar has more strength than the Canadian dollar. If the market is going down, if the price over here is going down, then the Canadian dollar has more strength than the Australian dollar. To make it more understandable, let's see. This is the US dollar against the Canadian dollar. So obviously, people that live in the United States and Canada, we understand that these are volatile together. They're going to be more volatile together, but we see that the US dollar gained more strength this week than the Canadian dollar. And a couple weeks ago, in early October, the Canadian dollar has more strength than the US dollar. All right. So that's an easy way to understand. And then you got the price of the currency right here on the right side of the screen. The third key and the final key is to know what you are risking, guys. Risk management is the absolute truth and gospel to trading in this financial market. I know a lot of people love to flip accounts, love to do it, and they desire to do it, and they have a thrive to do it. But guys, remember, risk management is key, because if you don't know how to risk, do not expect that you're going to be able to start managing big sums of capital that are not yours. So if you have a $100,000 account, just making 10% of that account a month is just $10,000 that you profited in this financial market. So you don't have to worry about flipping 100,000 to 200,000, because I mean, $10,000 you made by just making 10% of it. That's a lot. That's 6 figures in a whole annual year. That's more than a lot of people make annually, right? So risking what you have, and just like I tell people, the same amount of time it takes to make $1 in the financial market is the same amount of time it makes to make $1 million in the financial market. But I'm gonna get into that a little bit later, whenever I talk about pips and pipettes and calculating all that stuff to understand your risk management, guys, because it's very, very important to understand and know how to calculate all of this. But today I'm gonna mainly just talk about market structure and give a brief explanation of it right there for you. All right. So let's dive in. We went over the three keys of the three keys of trading in the financial foreign exchange market. And if you don't actually know, the foreign exchange market actually stands for the Forex market. Okay, the Forex market. So this is a blank pair right here. This is the US dollar against the Canadian dollar, right? And this is on MetaTrader 4. So MetaTrader 4 is an app that you can download onto your phone and that you can able to be trading and entering into the financial market yourself. But here we're looking at a blank demo account of the US dollar against the Canadian dollar on the 4-hour time frame. You can see it all on the left side of the screen. It explains it all to you right there. It explains where price is currently at. Price is currently at 1.332, right? We can literally see that, right? So let's see, market structure. The absolute only market structure that you should be paying attention to is only M's. Let me actually see if I can draw it on the screen. My bad, guys. Let me see. I'm trying to get a good marker to draw on the screen with. Okay. See, let me get it red. So we should only be worried about seeing M's, and part of my drawing, W's, and head and shoulder patterns, and inverted head and shoulder patterns. That should be the only thing that we should be worried about and trying to find in the market to enter into trades, right? So there'll be, I mean, I'll dive down into more about the Fibonacci later, all right? But I don't want to get too in depth in that and then confuse the newest person that could be literally watching this video that might not know too much about all that. So, okay. So typically we can find these patterns all over the place, right? We can find these literally all over the place. You see, I'm trying to get this marker back on the screen, but it doesn't want to. Hold on, guys, my bad. Oh, I'm trying to see something, guys. No? I'm having a little technical difficulties trying to grab the marker here. Give me a second, guys. Got my marker again. Okay, so we can basically see right here, wherever, oh, that was bad. All right. So guys, we can basically see what I'm talking about right here. So imagine prices going down and the Canadian dollar is gaining strength, but we got a little pullback and it drives all the way back down and then price comes down, then breaks the recent high, okay? Price is breaking recent highs, comes back down, and shoots up. That right there, ladies and gentlemen, that right there is considered a head and shoulders pattern right there. That is what I mean by the definition of a head and shoulders pattern, all right? You're gonna see many of those price moves often in puzzles, that you're always gonna see this in the market somewhere, somehow, some way. You're never not gonna see this type of stuff. You're always gonna see inverted head and shoulders, right? Or regular head and shoulders, or M's, or W's in the market 24/7, because those are market structure patterns. So you better get used to seeing all that right there. Market structure patterns. And it's always going to be obvious, and it's going to be something that your eyes have to get accustomed seeing and witnessing. Just like this, that is an M formation right there. You might see 3 hits to the high, but it's still right there, market structure, a M formation right there. No matter what, no matter where you see it, just like this, head, shoulders pattern. Now, it is going to be completely obvious to find these things, but maybe for the newest person, it might not be too obvious. So let me erase all this drawing off the screen, right? Right. And let me find let's see what we can find. And actually, let me use my Fibonacci in this type of pair, and on this pair right here while I'm getting started. So always with the Fibonacci, you're always going to start from the low to the high. If in these period separators, price is moving within it, right? If price is moving within it, you are going to look directly in this area. So let me draw it a little bit more so everybody understands it. Oops. We're looking within this area right here between these dotted lines. All right. And part of my drawing, I mean, I'm not the best artist, but at least I'm striving to be. But all right, so we want to get it at the low, to the high. All right, we're gonna get it at the low to the high. That's where we want to get our Fibonacci directly at, right? And we want to wait until we see where price is actually moving. And where price is at right here is going to dictate. Let me just move right there so so we won't get confused on which part I was talking about. So we're talking about right there, and we move this, and then we just worry about what's going on here. So this is where we drew our period separated. I mean, we drew the area where we're looking at between the Fibonacci, right? And part of my straight lines, guys. Right there, all right? And we want to focus directly in that area because that is going to dictate what happens in the next week. Because we understand on the 4-hour time frame, and let me break this down a little bit more so everybody understands a little bit better. On the daily time frame, each candle represents a day. So there's how many days in the month? Let me remove this so I can go onto the time frames. and show y'all directly it. So on the weekly, this represents each candle here represents 1 week within the year. I mean, 1 week within the year. So there's going to be 52 candlesticks that we're going to be seeing on the weekly. Now on the daily time frame, between each period separator, we're going to be witnessing 1 month between that, and dividing that up by 30 or 31 candles or 29 candles, there's going to be a candle for each day representing. And as we go on to the 4-hour time frame, we're going to be seeing between these period separators, we're going to be witnessing 4 hours. Each candle is going to represent 4 hours. All right, 4 hours. And on the 1 hour, this is going to be each day is going to be between each of these period separators. So that's going to be maximum and minimum 24 hours, 24 candles that you're going to see regardless. And then on a 30-minute, you get the gist. Each candle represents 30 or 15, 5 or 1 minute on each candle. All right. So let's get back to what we were talking about before. All right. So let me just bring our chart back to this. All right. So we drew our period separator, or we drew our Fibonacci from the low of this candle to the high of this candle. And what we're looking for is it to dictate this next period separator, right? That's what we're using it for, to dictate the next period separator that we don't know yet about. So as we know is that the 23, and actually we don't even have to use this area, this period separator. Let's go use the most recent period separator, right? The most recent period separator, and let's work on the most up to date, because we already know and we already seen what could happen to the left side of the chart. But we want to dictate what's going to happen on the right side of the chart, right? That's what we're more important. That's what we're more focused on right there, is what's happening on the right side of the chart. All right. So this is the right side of the chart, all right? And this is what we're working on right here. All right. So what we're trying to do is dictate. We already drew from, we're trying to use last week's data to dictate the next week's data right here on the right side of the chart. We're trying to predict what this next week is the full move of it is actually fully going to do, and how is it going to help us out, right? So as we see and we understand our Fibonacci movements, we understand mainly that we're looking for market structure patterns. We're looking for our market structure to happen between the 23.6 and within the 0 of the Fibonacci right here in these two areas, right? That's what we're very, very focused on, is can we see a market structure pattern happen between here? And the market structure pattern we're trying to see is an M or a head and shoulders or whatever, an M or W within this market structure pattern. And until we can see that and find that, that is a clear confirmation for us to enter into the trade, right? So once we don't see that, but understand that Fibonacci is very, very important. It's very crucial to your trading. It can work anyhow within, because the 50 is also a key component to your Fibonacci, mainly because the 50 is always going to be the neckline or the right shoulder, like how this was. Because we've seen, like we mentioned earlier, this right here is just another inverted head and shoulders, right? So the 50 is very, very important. 23.6 and the 0 and the 50 are probably going to be your most important Fib retracement levels on your Fibonacci, if you know, because it's always going to be the neckline or it's going to be the right shoulder. Always, always, always. So please pay attention to it. And then we use our indicators, which is our stochastic, for another confluence for our trading at the end of the day. So let me just delete, let me just erase all of that so you can see some clean data on the chart, right? So as we see, these all, for the head and shoulders, the inverted head and shoulders, all have to be within separate period separators. They cannot be in the same period separators and be considered a head and shoulder. It cannot be this happening in a period separator and we're considering it to be a head and shoulders pattern. No, we can't do that, right? It's not, why is my computer bugging? Probably gonna get a new computer, right? So they cannot all be in the same period separator and it's still a verified head and shoulders. No, that's not the way that it works. And within this trading for the Benjamins, we really try to maximize off of getting a lot of confluence to at least become 95% accurate with our trading style. Because with regular trading, we understand that it's a 50-50, either you win or lose. But what we're trying to do is, at least with our confirmations, add in another 40 to 45%, or at least with confluence, to win the next trade, to which could give us up to 90 to 95% accuracy rate with winning this next trade, right? So we want to focus on that to make it as accurate as possible. We understand, okay, these are two lows right here, right? Those are two lows right here in this area. And we want, and price broke the recent high and came back down. We can understand that the chances of it coming back below this level is slim to none. But what we can then do, since we have our Fibonacci plays from the high to the low, we understand that, okay, it's above the 50. The 50 is a good area to retrace in this level and give us an accurate shot back up, right? So let's see how many pips that actually was. I'm trying to see. Let's see, you entered on the top of this candle. It's about 150 pips that you could have caught straight right there by catching this same trade in this little head and shoulder, inverted head and shoulders pattern right there. So that's how simple using your Fibonacci can work for you, especially on the higher time frames. And also, to give you a better, more confluence, before I get off and end this, end this video, because I don't want to make it too long. I want it to be something simple, something small, until I can get a course out or whatever, probably in the next year or whatever, because this is 2020. Hopefully by 2021, I can develop a course and get it up together and give people some very, very realistic data as my trading journey continues to expand and to grow on a daily basis. Is to using your confluence with market structure patterns, your Fibonacci, your period separators, along with your indicator, which is the stochastic, right? The stochastic is very, very important. It can give you accurate trades more likely than not, okay? It's just another addition for your trades. So as you see, every time it was overbought, which is, I mean, if it's underneath these two lines right here, that means it is oversold. If it is above these two lines right here, that means it is overbought right there. So just like over here, we see prices overbought. And that gave us a good indication to buy this pair straight up. Just like over here, it is overbought, right? and it was a buy. Over here, overbought, and we bought. Same thing, every other area, overbought, overbought. And just like whenever we see it's oversold, ugh, vice versa, guys. If it's overbought, it's going to be up here. If it's oversold, it's going to be down here. So those parts where we were buying in that area, it was oversold. Too many people in the market were selling. And just like here, this was over what? Overbought. And so it gave us indication to sell that same pair in that direction straight down. Just like at any point here too, it was oversold. Overbought, right? And we see in the other areas too that we can see that these same areas are key indications in the market to become very, very successful in the market, to help us out to grow as successful traders in the market, right? So, and that's exactly how we can use this strategy in the market to help us make, no matter if it's $1 in the market or $0 in the market, or even $1 million in the market, we can use this strategy to change our whole entire life, guys. So I wanted to create this video just to make sure that we are working on a daily basis to help the new traders become self-sufficient and more efficient as traders. It's like I said, this is the first video of many for my YouTube series, giving you a brief explanation and giving new traders a new way to trade in the foreign exchange market on a daily basis using MT4. Thank you guys. Tune into the next video.